In 2005, two investors each put $100,000 to work. One bought farmland in Iowa. The other bought a rental property in Atlanta. 20 years later, one of them made 3 times more money than the other. And it's not the one you think. Today we're breaking down the actual numbers, year by year, dollar by dollar, to reveal which asset class truly won the 20-year money race. The year is 2005. George W. Bush has just started his second term. The housing market is on fire, prices have doubled in just 5 years, and everyone believes real estate only goes up. Meanwhile, in America's heartland, farmland is trading at an average of $2,140 per acre, almost exactly where it sat a decade earlier. Nobody on CNBC is talking about cornfields. Our two hypothetical investors each deploy exactly $100,000. Investor A buys 47 acres of Iowa cropland at $2,140 per acre and leases it to a local farmer for $138 per acre annually. That's a 6.4% cash yield from day one, with zero property management headaches. Investor B puts $100,000 down on a $400,000 rental home in suburban Atlanta. After mortgage payments, insurance, property taxes, and a management fee, the net rental yield is about 5.2% on the total property value. But here's where it gets interesting. Investor B is using 75% leverage. That $100,000 down payment controls $400,000 in real estate. And for a while, this leverage looks like pure genius. While the world was obsessed with flipping condos in Miami, farmland was putting together one of the greatest runs in investment history. Between 2005 and 2014, the NCREIF Farmland Index delivered staggering returns. In 2005 alone, farmland returned 18.7%, driven by soaring commodity prices and growing global food demand. The next year, another 14.2%, then 16.5% in 2007. But here's what makes farmland truly remarkable. When the financial crisis hit in 2008 and the S&P 500 collapsed 37%, farmland returned 15.8%. When housing prices cratered by 19%, farmland kept climbing. According to the NCREIF, farmland has delivered positive returns every single year from 1991 to 2023, 33 consecutive years without a loss. The only negative year in the index's entire history was 2024, when it dipped just 1%. By 2014, our farmland investors' original $100,000 had grown to approximately $382,000, nearly 4x in under a decade. And remember, this is from an asset that most financial advisors don't even mention. Now let's check on Investor B, the rental property owner. From 2005 to 2006, things looked amazing. The Atlanta property appreciated 8.3%, adding $33,200 in paper equity on top of rental income. Life was good. Then the music stopped. The subprime mortgage crisis didn't just slow the housing market, it destroyed it. Between 2007 and 2011, the Case-Shiller Home Price Index fell 27%. Our investors' $400,000 Atlanta rental dropped to roughly $292,000. That's $108,000 in lost value, more than the entire original investment. And here's what the return charts don't show. During the crash, vacancy rates spiked to 11.1% nationally. Tenants stopped paying rent. Our investor faced months of zero income while still paying the mortgage, taxes, and insurance. According to RealtyTrac, over 3.8 million foreclosure filings hit in 2010 alone. Many rental investors who used leverage, just like our investor B, lost everything. Our investor survived, but by 2012, their total equity had shrunk to roughly $68,000. 7 years in, and they were underwater. But here's the thing about real estate crashes. They create the conditions for massive rebounds. Starting in 2012, the U.S. housing market began one of the longest bull runs in history. Between 2012 and 2021, home prices rose approximately 107% nationally according to the Case-Shiller Index. Our investors' Atlanta property climbed from $292,000 back to over $604,000. But the real magic was happening on the income side. Rents surged. The average U.S. rent increased 42% between 2012 and 2022, according to the Bureau of Labor Statistics. And because our investor locked in a fixed-rate mortgage at 2005 prices, their cash flow improved dramatically every year. By 2021, our rental investors' total position, combining property equity, accumulated rental income, and mortgage paydown, reached approximately $578,000. The 75% leverage that nearly destroyed them during the crash had now become their greatest asset. Let's talk about what you actually put in your pocket each year. Farmland income is remarkably consistent. Cash rent yields for U.S. cropland averaged 3.1% to 3.8% annually over the past 20 years, according to the USDA. Our Iowa farmland generated roughly $6,400 in year one, growing to about $12,600 by 2024 as rental rates climbed with land values. Total cumulative income over 20 years, approximately $176,000. Rental properties, on the other hand, are a roller coaster. In good years, net rental income after expenses, vacancy, and maintenance averaged 4.5% to 6% on property value. In bad years, especially 2008 through 2011, income dropped to near zero or went negative after carrying costs. Our Atlanta rental generated total net income of approximately $224,000 over 20 years, higher than farmland, but with significantly more volatility and hands-on management. After accounting for property management fees, maintenance reserves, and vacancy losses, the income gap narrows considerably. This is where farmland truly separates itself. According to data from the NCREIF, farmland had a standard deviation of just 6.84% between 1992 and 2020. The S&P 500, 16.9%, gold, 14.8%, and residential real estate, including rental properties, came in around 12 to 15% depending on the market. What does that mean in plain English? It means farmland values move about half as much as stock prices and significantly less than housing. During the 2008 financial crisis, when the S&P 500 dropped 37% and housing fell 27%, farmland gained 15.8%. During the dot-com bust from 2000 to 2002, when stocks lost 42%, farmland gained 14%. This inverse correlation is incredibly rare in investing. Most assets fall together during a crisis. Farmland simply doesn't. The reason is fundamental. People always need to eat. Global food demand grows about 1.4% per year regardless of interest rates, recessions, or stock market panics. Both asset classes offer significant tax benefits, but they work very differently. Rental property owners can deduct mortgage interest, depreciation, property taxes, repairs, and management fees. The biggest advantage is depreciation. You can write off the building value over 27.5 years, creating paper losses that offset rental income. A $400,000 property with a $320,000 building value generates $11,636 in annual depreciation deductions. That's $11,636 in income you don't pay taxes on. Farmland investors get a different set of tools. Agricultural land qualifies for 1031 exchanges, allowing tax-free swaps between properties. Many states offer agricultural use exemptions that slash property taxes by 50 to 90%. And qualified farmers can deduct equipment, seed, fertilizer, and conservation improvements. The IRS also offers special installment sale provisions for farmland that can spread capital gains over decades. For pure tax efficiency, rental properties have the edge thanks to depreciation. But farmland's lower property taxes and 1031 flexibility make it competitive. Here's what the Instagram real estate gurus never tell you. Rental properties eat cash. The average landlord spends 1 to 2% of property value annually on maintenance. That's $4,000 to $8,000 per year on a $400,000 home. Then there's property management at 8 to 10% of gross rent. Vacancy losses averaging 5 to 8% annually. Tenant turnover costs of $3,000 to $5,000 per turn. and occasional catastrophic expenses like a new roof at $12,000 or an HVAC replacement at $8,000. Over 20 years, these hidden costs consumed roughly $142,000 of our rental investors' gross returns. Farmland. The costs are almost laughably simple. Property taxes, which are slashed by agricultural exemptions. Occasional soil testing. Maybe a fence repair. Total annual carrying cost for our 47-acre Iowa parcel averaged about $1,200 per year because the tenant farmer pays for seeds, equipment, labor, and crop insurance. 20-year carrying cost for farmland, approximately $24,000 versus $142,000 for the rental. Now we need to address the elephant in the room: leverage. Our rental investor didn't just invest $100,000. They controlled $400,000 in assets with $100,000 cash. That 4-to-1 leverage ratio is the single biggest advantage of rental real estate. When home prices rose 5% in a year, that $20,000 gain on a $400,000 property represented a 20% return on the $100,000 invested. Leverage turns modest appreciation into extraordinary equity returns. Our farmland investor, by contrast, bought land outright with no mortgage. Every dollar of appreciation was real, but there was no leverage multiplier. Now here's the critical nuance. If our farmland investor had also used leverage, and agricultural mortgages are readily available at 60 to 65% loan-to-value, their returns would have been even more spectacular than the rental. But most farmland investors don't use leverage because they don't have to. The returns are strong enough without it. And that's actually the point. Farmland delivers equity-like returns without requiring the risk amplifier of debt. Rental properties need leverage to compete. Between 2020 and 2023, inflation surged to levels not seen in 40 years, peaking at 9.1% in June 2022. How did our two investments respond? Farmland was a near-perfect inflation hedge. The USDA reported that average cropland values jumped 12.4% in 2021 and another 14.3% in 2022, directly tracking the inflation spike. This makes intuitive sense. Food prices rise with inflation, farmers earn more, and they can afford to pay higher rents for land. Rental properties also benefited, but with a lag. Home prices rose 18.8% in 2021 and 5.5% in 2022, according to Case-Shiller. Rents climbed too, though many landlords with existing tenants couldn't raise rates fast enough to match true inflation. Historical data confirms this pattern. Over the past 50 years, farmland has shown a 0.71 correlation with inflation, one of the highest of any asset class. Residential real estate correlates at just 0.38. After 20 years, let's tally the final scoreboard. Investor A, the farmland buyer, started with $100,000 in 2005. Through appreciation alone, that Iowa farmland is now worth approximately $527,000, based on USDA data showing cropland values rising from $2,140 to over $5,830 per acre by 2024. Add cumulative rental income of $176,000 minus carrying costs of $24,000, and the total return is approximately $679,000, a 579% gain on the original investment. Investor B, the rental property owner, started with $100,000 down on a $400,000 home. That property is now worth approximately $720,000 based on Case-Shiller data. After paying off mortgage principal and subtracting all expenses, total equity plus net income comes to approximately $614,000, a 514% gain. Farmland wins on raw total return, $679,000 versus $614,000. But more importantly, farmland achieved this with roughly half the volatility, no leverage risk, virtually zero management burden, and 33 consecutive years of positive returns. The investment nobody talks about quietly outperformed the one everyone obsesses over. If this breakdown changed how you think about investing, smash that subscribe button and turn on notifications so you never miss a property-ranked deep dive. Here's the question I want you to answer in the comments. If you had $100,000 today, would you buy farmland or a rental property? And why? Drop your answer below. I read every single comment.